G'day there guys and girls, Michael Beresford back again for today's Property Wealth WOD. Got a fantastic WOD for you today. For those of you that like your numbers, like me, this one's pretty juicy, so sit back, relax, pay attention. I'll walk you through it, but it's going to be on the more complex end of numbers, but will really help you understand one of the fundamental issues with property, which is affordability. Had a bit of feedback after last week's WOD where I talked about three key things that people need to be able to exercise or put into place to be able to get started in the property market. So quick recap, we were talking about sacrifice, making sacrifices on cash flow. We were talking about delayed gratification, so not just getting something when you want it, but actually putting it off. And the third thing was patience. Remember that real wealth is not created overnight. It takes time and you need to be committed to staying the course. So in line with that, we get so many questions around affordability. Obviously it's in the press and people feeling that because the Sydney median house price is pushing $1 million and Melbourne's median house price is nudged over 800 grand, property is just unaffordable and it's not attainable. Remember that buying blue chip property as your first property is always going to be a stretch. I don't know many people that can do it, yeah? And most people that do own blue chip property have held property for years and accumulated their wealth. So that's what we're going to go through today, is a case study using median house prices and an extended journey of about 45 years to help you understand why property price growth is not unreasonable to expect now and ongoing, and how that's happened. Okay, this is really conservative. Most of you that know me will know that that's how we operate. So this here is a diagram over the last 46 years of median house prices on the left-hand side here, okay? Melbourne median house prices. So the median house price in 1970 was 13K. In 1980, it was 44. 1990, 147, 253, 559, and a smidgen over 800 today. Okay, so that's what those numbers mean. I do apologise for the pictures of the houses. You think after doing this for 15 years I'll be able to do better at it, but I'm not an artist. What we've got here is a progression assuming that people are upgrading their principal place of residence every 10 years. Now, for those of you that have seen our WODs on rent versus own and how you pay your own home off in 10 years and not 30, will understand the debt curve and the fact that it uses a lot of cash flow on an ongoing basis to upgrade your house every 10 years. You're going to be far better off being in there for a longer period of time, but this will illustrate the affordability thing that we're focusing on today. Okay, so what we're talking about here is, let's say that this was the first property that you bought back in 1970 and you paid the princely sum of 13 grand. Okay, the median house price in Melbourne back in 1970. Let's assume that you have about an 85% deposit plus costs like stamp duty. So your loan when you buy the property is this top number in red here, 11K. So you've got a property worth 13, you've got an $11,000 loan, and what we're assuming over the next 10 years is that you reduce your loan by about 20% over that 10-year period. So not unreasonable given that loans back then 25 years and they're now 30 years. So to only reduce it by 20% in a third of the loan time is pretty conservative. Okay, so your loan in 10 years time in 1980 when you sell this property is 9K. Okay, so the mortgage has come down by $2,000. Let's say that in 1980 you sell this property because it's a median type property. Let's say you sell it for the median house price in 1980, which is $44,000. By the time you've paid your loan off of 9K, then you've got $35,000 cash deposit towards your next property. Okay? Now, this $35,000, you're not going to simply sell one house and buy something equivalent. That's not human nature. We're always upgrading and looking to buy better. Okay? So what we've got here, the number on the right, is the purchase price of the new property. So we're selling for the median price and we're upgrading to the tune of about 10% and spending $50,000 in 1980 on our new principal place of residence. Because we've got $35,000 as the deposit for this property, then our loan is going to be $15,000 plus we're going to have stamp duty and some other costs. So let's assume it goes to $18,000 as a total loan amount. Same principle. Over the course of the next 10 years, we reduce the loan by about 20%, which means that it's 14. We sell this property while it's above median. I'm just being conservative and assuming that we sell it for a median house price. So trying to put some quantitative numbers around this for you to understand it. If we sell this property in 1990 for the median house price of $147, and we pay out the loan of $14,000, we've got $133 left as the cash deposit for our next upgrade, which would be maybe $175,000. Okay, hope you're following. We simply work this process through. So, because we've got 133, okay, and we're paying 175, then the difference there, okay, is 42,000. Add some costs for stamp duty, solicitors, etc. Let's assume the loan's 50K. Pay it down by 20% over the 10 years and sell this property 10 years from then in 2000 for 253. Pay out the loan of 40K. We're left with 213. Okay, so hopefully you're following this. I'll move it through just so we can get to the crux of it. But basically, as you go, you can see what the loan starts at when you pay this purchase price, what you could naturally assume to pay it down by over 10 years, and the amount that would be left as your sizable cash deposit for the next property right through to 2010 and again onto 2016. So if this property here, bought for $320 in 2000, was sold for the median house price in 2010 of $559, you've got $464, add some costs, the mortgage will be $270. You've paid it down to about $220 over the 10 years. And if you're looking to, in this case in 6 years, because let's say we're buying it today, okay, then we've got 500, sell it for 804, minus the 220, gives us 584 as a cash deposit. Buy a $1.1 million property, add some costs, and a mortgage is 570. Okay, so firstly, I hope you've found that insightful in terms of how price growth has moved over a 45, 46 year period in Australia. The more fundamental takeaway, however, from this is that it's unreasonable to assume that just because someone's paying over $1 million for a property, which seemed completely unrealistic, a few decades ago, doesn't mean that they're borrowing to the same loan to value ratio at 80 or 90% as what people did to get into their first property. Some people will do it, but in terms of general numbers, okay, what you can see here is that this loan to value ratio is only about 50% of the property's value. And remember that we've been through this super conservatively, assuming that every upgraded house every 10 years is just selling for the previous median house price. So realistically, this number is going to be quite a lot lower. Or if you wanted to have a loan of 570, this purchase price could be quite a lot higher and the loan to value ratio would be even lower again. Okay, so rule number one with affordability, guys, okay, just because the median house price seems high and it might seem unachievable, bring it back to the basics. Make some sacrifices, delay gratification and be patient. Do whatever's possible to be able to get into your first property. I'm sure our parents and our grandparents will happily tell us that they scratched and scraped to buy their first home for the princely sum of about $13,000 nearly 50 years ago. If they'd just done that and bought their upgraded principal place of residence every 10 years, which doesn't make a lot of financial sense from a cash flow perspective, you can see why houses well above the median house price are easily being bought with low loan to value ratios. Coupled with that the banks are applying big loadings on top of actual interest rates today for servicing calculations, and you can start to see why it's not uncommon that purchase prices around $1 million and above seem to be selling every day of the week. So there's Affordability 101 over a long-term journey for you guys. Hope you found that useful. Great talking to you. We'll see you next time.